Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into Intuitive Surgical Inc., ticker symbol ISRG. This is a company that has, well, it's arguably defined an entire generation of surgical robotics. Our mission today is very focused. We're going to thoroughly analyze the stack of financials, the clinical research, and the strategic outlooks you've given us to form a really clear investment thesis.
And that thesis has to grapple with this massive tension that's just inherent in the name. The core conflict is really this. ISRG is betting its unbreakable moat, and accelerating 20% procedure growth will successfully compound value and justify a premium 75x forward PE valuation. All of this despite the increasing threat of GLP-1 drug disruption and, intense competition from rivals like Medtronic and J&J.
That 75x forward PE, that's not just a high number, it's an expectation of flawless execution. It basically requires us to assume that every potential headwind is either, non-existent or it's already been solved. So we have to dissect the components of this business model. We need to determine if the Q3 2025 performance and their latest tech, especially the da Vinci 5, Ion, and SP platforms, if they truly insulate them from the structural risks that are, well, they're clearly escalating. Let's start with the cornerstone, the underlying financial power of this whole enterprise. What did the most recent quarter really tell us about their strength?
The Q3 2025 results were, well, by any measure, just a robust affirmation of their continued dominance and their operational efficiency. Total revenue for the quarter hit an impressive $2.51 billion.
Okay, $2.5 billion.
And that represents a strong 23% increase year over year. But here's where it gets really interesting, where the financial efficiency shines through. Non-GAAP earnings per share, or EPS, that grew even faster.
Faster than revenue.
Much faster. It rose 30% year over year to $2.40.
Okay, so that acceleration in EPS growth, 30% versus 23% on the top line, that screams operating leverage. It means their costs just aren't scaling as quickly as their revenue is coming in. The benefits of scale are flowing right to the bottom line.
Exactly. The sheer power of the model is, it's just evident in the raw cash generation. GAAP net income for the quarter came in at $704 million, or 1.95 per share. And for the listener who's focused purely on liquidity, on resource deployment, the company generated a staggering $736 million in free cash flow just in that quarter.
These aren't just good numbers. They establish a foundation of stability that, very few companies, even in high-growth medtech, can really match.
They really can't. But the real structural advantage, the secret sauce, is in how that revenue stream is actually built.
You're talking about the recurring revenue, right? The high percentage, which is, it's the envy of basically every capital equipment company out there.
Precisely. This is the financial fortress. A whopping 84% to 85% of Intuitive's total revenue is classified as recurring.
84%.
Just think about that for a second. This isn't lumpy cyclical revenue. It's not tied to a hospital making a multi-million-dollar decision once every 5 years. No, this revenue is generated through the consistent, mandatory consumption of instruments and accessories, INA.
So effectively, once a hospital commits to the da Vinci ecosystem, they are just locked in. They have to purchase proprietary high-margin consumables for every single procedure. You can't run a surgery without them.
Can't. And that ensures revenue is not only predictable, but also highly profitable. It gives them almost total insulation from those purchasing cycles that really slow down their peers.
It creates a high-velocity, high-margin flywheel.
It does. And you can see the result of that phenomenal cash generation right on the balance sheet. Intuitive ended the quarter sitting on $8.4 billion, with a B in cash, cash equivalents, and investments.
That is an enormous war chest. When a company is that cash-rich, management's capital allocation strategy, it just becomes critically important. So are they deploying that defensively, or are they getting aggressive and returning it to shareholders?
They're being aggressive on the return side, for sure, but they're also being notably prudent on the spending side. They repurchased approximately 4 million shares for $1.9 billion just in Q3.
Wow.
Which, shows a lot of confidence that they think the stock is undervalued relative to their long-term growth. It's a very effective way to use that excess cash. But here's the strategic nugget. Management emphasized that despite their massive CapEx plans, and they are planning major investments in new facilities, manufacturing scale-up, commercial infrastructure, new training centers globally.
So a lot of spending.
A lot of spending. But all of it for 2025 is expected to be funded directly from the cash generated by the business.
Wait, hold on. So they're planning a massive global expansion, but they don't even need to touch that $8.4 billion stockpile to do it.
Correct. The machine is just so potent at generating free cash flow that it is self-funding its own acceleration and its own expansion.
That raises an interesting question for us, though. If they have that much capacity and that much cash, are they being aggressive enough? I mean, are there strategic acquisitions they should be chasing to accelerate their platforms? Or does this huge pile of cash signal that there just aren't enough external growth opportunities that meet their high standards?
It's a key tension point. A very good question.
And while the core financials are spectacular, you did mention a minor headwind. We should probably touch on that before we move to the moat. Was there any pressure on those, those legendary margins?
There was, yeah. Though it was, minor and largely expected, management noted a slight decline in the Q3 pro forma gross margin. It went down to 68% from 69.1% a year ago.
Okay, so a small dip. What's driving that?
It was attributed to a few things coming together. First, you have external macro factors like tariffs. Second, the internal costs of building out that global infrastructure. And third, a mix shift.
The mix shift is interesting. Does that mean we're seeing lower margins on the new, highly anticipated products?
Yes, that's part of it. The mix shifted toward revenue from the newly launched da Vinci 5, the DV5, and the Ion platforms. New platforms, even though they're high growth, they're initially lower margin, they're still scaling up manufacturing efficiency and absorbing higher facility and training costs.
Right.
So that pressure, combined with the tariffs, led them to revise their 2025 pro forma gross margin guidance down a little bit, to 65% to 66.5%.
So still elite margins, but maintaining them requires a lot of investment and it faces some clear macro pressures.
Exactly.
Okay, so the core business is robust, it's cash rich, but dominance requires this continuous costly investment. Let's pivot now to the structure that protects this entire operation. You called it an unbreakable moat. What exactly defines Intuitive's dual structural defenses against these deep-pocketed competitors who are finally, showing up?
It truly is a dual moat, and it operates on two different levels.
Yeah.
You have the economic, sort of physical level, and then you have the human and institutional level. The first barrier is just high switching costs and the ecosystem lock-in.
Yeah.
A hospital isn't just buying a machine, they're investing in a comprehensive, multi-million-dollar, multi-year program.
We're talking about a system that costs millions of dollars to install, plus all the construction, the infrastructure, maintenance, IT integration. It's not like, trading in a laptop.
Precisely. The hurdle is immense. To replace that system involves massive financial outlay and just a huge amount of operational risk. And that lock-in is enforced by this holistic proprietary ecosystem. The robotic systems themselves, the INA that you have to have, the support services, and the digital portfolio, which is getting more and more important. Things like the Intuitive Hub and the My Intuitive app.
And this isn't a small footprint.
It's massive. The install base is at 10,753 da Vinci systems worldwide as of the end of 2024. This isn't some small collection. It's the standard of care in thousands of major hospitals around the globe.
That physical footprint alone, that represents decades of a technological head start and institutional buy-in. But that second barrier, the human element, that might be even more powerful in creating inertia.
It is the ultimate source of stickiness. The surgeon training lock-in. Intuitive has invested so heavily in creating a standardized, rigorous training pathway. They have trained nearly 90,000 surgeons globally.
90,000.
It's a massive professional and educational commitment from the clinicians themselves. Hospitals dedicated entire departments to using these systems, building up competency with intuitive learning, with simulators like SimNow, and dedicated in-person training centers.
I can just imagine the institutional resistance. If a hospital CEO decides, okay, we're going to switch to a competing platform, they're not just disrupting the supply chain. They're telling 50 of their senior surgeons all the time, all the effort, the certification you spent mastering the Da Vinci is now obsolete. You've got to start over on a system that's, basically unproven.
That inertia is exactly the defense. The risk of disrupting an established clinical workflow, of demanding thousands of hours of retraining from these highly specialized, high-demand surgeons. It's often just economically and politically impossible for a hospital executive.
Even for a discount.
Even if a competitor offers a system at a 10% discount, the risk of a dip in competency or procedural volume during that transition is just so much greater than any capital savings.
So to make that lock-in defensible, Intuitive has to constantly prove its value. It can't just be about the tech. They need to show hospital CFOs that this expensive program is actually saving them money and improving patient care. How do they do that?
They align their pitch directly with what the industry calls the quintuitive aim. It's a framework that aims to demonstrate that robotic surgery improves 5 key areas: better patient outcomes, better patient experience, a better experience for the care team, lower total cost of care, and finally, increased access to care.
Okay, focusing on that lower total cost of care, that's where the rubber meets the road for a hospital budget.
Yeah,
What's the hard data they're citing?
the clinical data is now. It's undeniable and it's highly compelling. The most crucial recent data point comes from the COMPARE study. This was a comprehensive review and meta-analysis published in the Annals of Surgery in October 2024. And this study provided the exact empirical evidence that finance teams need to justify spending the money.
And what was the big takeaway for those administrators?
The study showed that robotic surgery patients stayed, on average, 1.9 days less in the hospital than patients who had a comparable open surgery.
1.9 days.
If you translate 1.9 days saved across thousands of procedures every year, that represents a massive reduction in the fixed costs that come with bed occupancy, nursing time, potential complications. It's a direct, measurable ROI for the hospital.
And that's critical. I mean, saving bed days in a major hospital is a proxy for optimizing some of the most expensive assets they own.
Absolutely. And on top of that, the studies show improved patient outcomes that also reduce downstream costs. There's other evidence, for example, in complex procedures like robotic cystectomies. It showed that compared to traditional laparoscopy, robotic use was associated with a lower risk of serious complications, a lower rate of having to convert to open surgery, and a lower risk of hospitalization for more than 24 hours. This constant stream of validated, high-quality clinical and economic data, it just reinforces the moat. It makes switching from intuitive, not just disruptive, but economically irrational.
That is the foundation. You have financial strength protected by these powerful moats, all validated by hard data. Now let's shift focus to the key catalyst that's driving the stock today, the next generation, the da Vinci 5 or DV5. This is crucial because it has to be technically superior enough to force hospitals to upgrade, even when their older SHE system is, perfectly capable.
The DV5 is absolutely the linchpin. It's for maintaining technological dominance and kicking off the next major upgrade cycle. It was cleared by the FDA in March 2024, initially excluding cardiac and pediatric indications. And the difference in the core capabilities it's staggering. The DV5 boasts 10,000 times the computing power of its predecessor, the SHE.
10,000 times. That almost sounds like overkill, but I guess it speaks to the sophistication you need to process all the data for improved vision, refined control, and most importantly, those integrated haptics.
That processing power is absolutely necessary for real-time haptics. The core innovation of the DV5 is that integrated force feedback system. Previously, surgeons operating the da Vinci were they were essentially relying on visual cues and their experience. They could see the tissue stretch, but they couldn't feel the tension through the instruments.
Which means they were relying on visual estimation, a technique that, sure, it requires immense skill, but it carries an inherent risk of applying too much pressure to really delicate internal structures.
Exactly. Force feedback lets the surgeon actually receive tactile data on the resistance, the tension, the texture of the tissue. It closes that sensory gap. And the early clinical data is already validating this. The design is working for improved precision and efficiency. There was a reported 55% reduction of maximum force during suturing when using the DV5 compared to the older systems.
A 55% reduction in maximum force, that's a monumental finding. It means less accidental trauma, better tissue handling, and theoretically a faster recovery, and a better outcome for the patient. And this ties right back into that surgeon lock-in. It makes the DV5 a demonstrably better tool, which reinforces the need for surgeons to adopt this specific technology.
It creates a new level of clinical excellence, and the market is responding, and responding quickly. What we saw in Q3 2025 shows this accelerating momentum. Intuitive placed 240 DV5 systems in that quarter. That's a significant jump from the 180 systems they placed in Q2.
So the initial launch wasn't just a one-off spike. Adoption is actually speeding up. What about utilization? Are these systems just sitting there, or are they being immediately put to high-volume use?
They're being used immediately and effectively. Approximately 67,000 DV5 procedures were performed in Q3 alone. And management noted that the utilization rate for the DV5 is already outpacing that of the established da Vinci SHE platform at the same stage of deployment.
Wow.
This confirms that customers are upgrading and immediately leveraging those new capabilities.
And this upgrade cycle, it must be generating a significant number of trade-ins from the older systems. How is Intuitive managing that influx of used multi-million-dollar robots?
Domestic demand for the DV5 is definitely driving a strong trade-in cycle. There were 141 trade-in transactions in Q3. That's a sharp increase from only 38 in the prior year. And this creates both a strategic challenge and, an enormous opportunity.
Let's talk about that opportunity. They can't just scrap these machines. I mean, they're perfectly functional, highly advanced technology that cost millions of dollars to begin with.
They become a strategic weapon. The refurbished Qi systems are being strategically redeployed to expand market access, particularly in price-sensitive environments. The target market here is the ambulatory surgery center, or ASC market. These centers often do high-volume, less complex procedures, and they're generally much more cost-sensitive than a major hospital.
This is a textbook, brilliant competitive strategy. Medtronic and the other rivals are trying to enter the market by talking about lower upfront costs and modularity. And Intuitive is effectively using their own retired but still superior fleet to preemptively lock up that low-cost, high-volume market before their competitors can even establish a foothold.
Exactly. They are defending the entire economic spectrum at the same time. The premium, complex procedures with the DV5 and the cost-sensitive, high-volume procedures with the refurbished Qi. They've sold 20 refurbished Qi systems so far, and this strategy just locks in future I&A revenue streams from a whole new, growing customer segment.
That structural defense is highly impressive. Now let's zoom out from the hardware and look at the actual growth metrics. That 20% overall procedure growth needs to be sustainable to support this kind of valuation.
The 20% total procedure growth in Q3 2025, that's the metric that validates the whole model. And we're seeing broad acceleration. If we look specifically at the U.S. market, growth accelerated to 16% in Q3. That was up from 13% in Q1.
And outside the U.S.,
Even faster. Procedures grew about 23% in 2024, which reflects that earlier stage of market penetration internationally.
what's driving that acceleration in the mature U.S. market? Are they successfully moving into new types of operations?
The acceleration is coming predominantly from general surgery applications. These are high-volume procedures that touch a massive segment of the population. We're seeing robust uptake in common procedures like hernia repairs, gallbladder removals, and increasingly complex colorectal surgery. And that strength in general surgery is so crucial because it represents this huge untapped pool of potential procedures that's just less prone to sudden regulatory or demographic shifts than some of the more specialized areas.
And beyond the core Da Vinci platform, Intuitive is making these big investments to broaden its portfolio, to capture new procedural markets through specialized platforms. How are Ion and SP contributing to the growth story?
They are contributing exponentially, mainly because they're earlier in their life cycle. Let's start with Ion. That's the robotic bronchoscopy system designed for lung nodule diagnostics. Ion procedures grew by an astonishing 52% in the quarter. And utilization, the average number of procedures per system, that was up 11%.
The Ion platform must have a pretty significant clinical advantage to drive that kind of growth, especially in a diagnostic field where precision and safety are just non-negotiable.
It does. Ion provides a truly compelling clinical narrative. A multi-center study demonstrated its efficacy, showing a high diagnostic yield of 90% for small pulmonary nodules. But here's the major differentiator. The study reported 0 pneumothorax observed.
0 pneumothorax, a collapsed lung. That's a massive safety metric. For traditional biopsies, pneumothorax rates can be substantial. Sometimes they require emergency procedures or longer hospital stays. That 0 result must be incredibly attractive.
It completely transforms the risk profile for small nodule biopsies. The Ion install base reached 805 systems by the end of 2024, and that combination of high diagnostic yield and safety is just accelerating adoption.
And the Da Vinci SP single port system, that one targets a very different set of procedures, focusing more on access than broad abdominal surgery.
Correct. The SP system is designed for complex procedures where the surgeon needs to get into these narrow, confined workspaces, often through a single small incision. Think urologic procedures, transoral otolaryngology, specific colorectal procedures. SP procedures grew dramatically by 91% in Q3, with utilization up 9%.
91%.
And while the installed base is smaller, 273 systems, its growth rate proves the utility of single-port access for these complex, specific surgical niches.
So if we add all this up, the massive installed base, the accelerating use of the DV5, and the exponential growth in specialized platforms like Ion and SP, what does that imply about their overall market penetration? Are we in the second inning here, or maybe the third?
We are still very, very early. And this is perhaps the most powerful argument for that 75x PE. Management looks at the total addressable market, and they're targeting a range of 7 million to 21 million annual procedures in the future. Now consider that they performed about 2.68 million procedures in all of 2024.
So even at the low end of their future projection, they're only penetrating about a third of the market. And at the high end, they haven't even scratched the surface of 15% penetration.
Precisely. The long-term potential for expansion into applicable surgery markets is just enormous, and this forward-looking opportunity is exactly what that premium valuation is pricing in. It assumes decades of double-digit growth are still ahead.
Okay, we have thoroughly defined the bull case. It's undeniable dominance, self-funding financials, a multi-layered moat, and this immense growth runway fueled by next-gen tech. Now we have to turn the coin over and confront the central conflict. Does this perfection justify the 75x forward PE, or are the risks of disruption and competition just too great? Let's get into the structural risks that threaten to destabilize that valuation.
And we start with a risk that is currently creating the most anxiety across the entire medtech sector, and that's the disruption caused by GLP-1 drugs, the highly effective class of weight loss medications.
The obvious concern here is the impact on bariatric surgery, right, which is designed to treat severe obesity.
Bariatric surgery procedures like gastric sleeves or bypasses is a small but highly visible slice of Intuitive's business. It represents about $200 million globally, mostly in the US. While that's small in the context of their multi-billion revenue, it's a bellwether for disruption. And management did acknowledge a small dip. They reflected that as a high single-digit volume reduction in bariatric procedures.
Competitors and analysts have floated some really high projections, like a 20% to 30% reduction in bariatric volumes over time. How did Intuitive's management respond to that kind of prediction?
They characterized those projections as overly pessimistic, at least based on their own internal data and their conversations with clinicians. However, the long-term uncertainty, it remains massive. The big question is whether GLP-1s are a substitute for surgery or if they're a complement to it.
Let's explore that complementary angle because that's the bull case for this risk.
Yeah.
How could a drug that makes people lose weight actually help a surgical robot company?
The complementary thesis suggests a couple of things. First, GLP-1s might help morbidly obese patients achieve a lower BMI, which could actually qualify more candidates for surgery who were previously deemed too high risk for the operating table.
Okay.
And second, and maybe more importantly, obesity often leads to other complications. Hernias, gallbladder issues, reflux, which are all high-volume procedures for the Da Vinci system. If patients use GLP-1 but eventually stop, or if the drug doesn't fully resolve the underlying structural issues caused by years of obesity, those procedures could persist or even increase as patients become safer surgical candidates.
So the uncertainty isn't just about bariatric surgery itself, it's about the total metabolic surgery pool. But the market hates uncertainty, and that risk is just going to hang over the entire sector until we see long-term patient data.
Absolutely. The market is pricing in the risk of substitution, even if the long-term reality ends up being much more nuanced.
The second major risk is the intensifying competition from titans. Intuitive dominated this field for 2 decades, but now you have Medtronic and Johnson companies with comparable resources and market clout finally showing up.
And they are serious players. Medtronic, with its Hugo system, is heavily emphasizing modularity, portability, and potentially a lower upfront cost. They're aiming directly at that ASC market that Intuitive is now defending with its refurbished sheath lead. And then Johnson is developing its Ottava system, another deep-pocketed rival.
So are these competitors trying to beat the DV5 on features, or are they really just attacking the economic model and the accessibility?
They're primarily attacking the economic entry point and the accessibility. Their goal isn't necessarily to replace a DV5 in a major teaching hospital tomorrow. It's more to chip away at the edges with more accessible, lower-cost options. They want to establish a competing training and technology ecosystem in smaller hospitals and ASCs, which creates a critical tension for Intuitive.
That tension being, how does Intuitive maintain its premium price point and its superior margins when good enough robotic systems are now available at a lower cost?
That's the strategic dilemma.
Yeah.
Intuitive has to continuously prove that the incremental clinical benefits of the DV5, the haptics, the improved visualization, the digital portfolio, justify the higher total cost of ownership against a cheaper, credible competitor. If that performance gap narrows, the moat becomes less defensible on price, which would immediately start to erode those high margins the market is counting on.
Let's move to the third major risk, geopolitical and regulatory friction, particularly in those critical international growth markets. I'm thinking most notably of China.
China is complex. It represents about 5% to 6% of procedures and significant long-term expansion potential. But sales in China are highly volatile because of government planning. System sales there are governed by the Chinese government's 14th five-year plan quota. That quota only authorized the purchase of 559 new surgical robots for the entire country over that whole period.
So they're not selling into an open market. They are competing for a fixed, limited number of approved slots.
Exactly. It makes sales lumpy and entirely dependent on winning these centralized bids. Intuitive had only placed 121 systems under that quota by the end of 2024. And layered on top of all this, you have the ongoing government anti-corruption initiative.
What specifically is that initiative targeting, and how does that slow down Intuitive sales?
The initiative, which is expected to last about a year, is focused heavily on procurement decision makers and high-level finance people within public hospitals. This scrutiny has, naturally caused modest delays to capital tenders, the bidding process for the systems. Now, management optimistically views this as a delay, not a lost sale, but in a market that's governed by a strict quota, any delay in winning a tender means that slot might get pushed to a later year, or, worse, potentially lost to a local competitor if the quota closes.
And we also noted the tariff reality, which is putting pressure on the cost of revenues.
Tariffs, specifically on imports from Mexico, where Intuitive manufactures a huge majority of its instruments and accessories, are a material, near-term financial headwind. This is a direct input cost, and it contributed directly to that revised 2025 pro forma gross margin guidance of 65% to 66.5%. While they have plans to diversify supply chains long-term, this issue is a persistent drag on profitability right now.
Finally, we have to address the most direct challenge to their high-margin moat, the ongoing antitrust litigation.
This is a critical legal liability, and it strikes right at the heart of their business model. The antitrust litigation alleges that Intuitive maintains a monopoly on the EndoWrist instrument repair and replacement aftermarket. And since a vast majority of their revenue is recurring and high margin, derived from these proprietary consumables, any challenge to their control over this aftermarket is, well, it's existential.
Could you explain the complexity of those 2024 court rulings? Because they were a bit contradictory and confusing.
They were highly complex. In March of 2024, the court initially found in favor of the plaintiffs, ruling that Intuitive did hold monopoly power in that specific aftermarket for repair and replacement. That finding was devastating because it suggested their control over consumables could be legally challenged.
Right.
However, that specific portion of the order was then vacated in July 2024 after a successful motion for reconsideration. The crucial point, though, is that the underlying legal challenge is still unresolved. It is an ongoing liability risk that aims to force Intuitive to allow third parties to repair or replace their high-margin components, thereby dismantling a key pillar of their financial fortress.
And this brings us right back to the central tension. We have a company that just defines excellence, technological leadership with the DV5, a self-funding business model, the potential for multi-decade growth. Yet it carries a valuation that prices in zero failure, even as these structural risks of GLP-1s, accelerating competition, and legal challenges to their moat are clearly intensifying.
That is the core decision for you, the listener. Does the immediate success of the DV5 upgrade cycle, the immense long-term multi-million procedure potential, and that undeniable competitive moat outweigh the combined threats of the long-term GLP-1 impact, the necessity of defending their price point against deep-pocketed competitors, and the persistent regulatory and legal risks? The market, at 75x forward PE, is demanding perfection. And until these escalating structural risks stabilize or we see a definitive outcome in that antitrust fight, we really have to maintain a cautionary stance. It remains a hold candidate, one that rewards patience and demands clarity on the potential headwinds they will inevitably face in the coming years.
An incredibly comprehensive synthesis of a true market leader that is facing just unprecedented structural challenges. The takeaway here is the importance of evaluating the persistence of that competitive advantage, the ability of that 10,763 system installed base and those 90,000 trained surgeons to fend off the twin threats of disruption and cost-focused competitors against the extremely premium price you have to pay to own it today.
Risk defined, portfolio protected.